Everyone needs some bonds in their portfolio, but with less than exciting yields in recent years, what's the best way to do so? I'm Jack Otter, editor of BARRON'S.com. I'm here with Priscilla Hancock, Global Fixed Income Strategist for JPMorgan. So give us the big picture view. It's not a fast-growing world economy, and you say we're going to get even slower before it picks up.
Well, I think that's right. It isn't a fast-growing economy. In fact, we have global growth that's slowing. It's below trend. Not because we have that in the United States. We recently had a fear of recession. I think that was overblown. The market sold off more. We have growth in the U.S. that's 1.5% to 2%. That's around trend. Growth in Europe, it's around, if not slightly above trend. The problem is the emerging markets, who represent at least 40% of global growth, and they are slowing and below trend. And in the face of really slow global growth and no inflation, we're going to continue to see an environment where the central banks of the world are going to be accommodative. They are looking to try and stimulate growth any way they can, and that creates an interesting environment for investors, right? This is punitive for investors. And to your question, how do you find yield? I think you need to think about finding total return more than just finding yield, because some of the bank policies are actually creating an opportunity for capital gain.
And where are you seeing those opportunities? What you mean is that the yields will actually come down.
Correct.
And therefore the holders of current bonds will do well.
Correct. They seem low now. They're going lower. So two themes. I think, first of all, there's long-term investing. When you think about what's really happening, slowing global demographics, the fact that growth is going to continue to be slow before we get the next turn in demographics, it's probably 10 to 15 years from now.
This is the millennials coming into their productive years?
You have the millennials, and then you start seeing the second child in China, right? There's a lot of things around the world that means there will be growth in the future. But in the short run, 10 years, I think one of the key things would be saying is you want to own high quality duration. You have central banks around the world who are supporting long rates, who are keeping rates low and maybe going lower. And in the face of that, you want to own quality. You want to take advantage of that through high quality duration. In the United States, that might mean things like agency mortgages. We like things like Australia duration, long Australian bonds. Now you might say, why?
I would.
Australia is tied to China. As a result, they're slowing. And what are they going to have to do? They're going to have to ease. They're going to have to lower rates even further. That's an opportunity for capital gain.
Which is a very interesting point, because if you think about the Australian stock market hasn't done so well because it was commodity heavy. That's
exactly
gotten hammered.
Right.
Could be good for bonds.
Exactly. Could be right for bonds. And of course, we know that from our own experience in the United States. Usually a poor stock market is a good bond market. Other places that are benefiting from easy monetary policy and where duration is attractive, places like peripheral Europe. Italy and Spain might not have been your first guess either, but a lot of the growth that we originally saw in France and Germany spreading to the periphery, and then it's spreading into the emerging market countries that are also benefiting, like Hungary and Poland. So we like duration as a long-term trade. Short-term, tactically, there are some really interesting opportunities in risk assets, things like high yield. That market got completely sold off over the last few months. Now, we've had a rally in here, so it's not as attractive as it was a month ago. But when you look at the fundamentals of most high-yield companies with a U.S. economy that's not about to go into recession, we would suggest that the spreads are still wider than they need to be. They probably need to be more than they were historically, because you have to be compensated for higher volatility and more illiquidity in the bond market. But nonetheless, we think there's some attractive opportunities in the U.S. high-yield market, not yet in energy. That market probably isn't cheap enough for us to get in, but U.S. high yield. And then European high yield is a very attractive opportunity, and people are usually surprised. It yields less than U.S. high yield. But on a spread basis, so double B spread in Europe, very similar to a double B spread in the United States.
In other words, the difference between those credits and what the government bonds
Correct.
are yielding in Europe.
Right, and that's the difference, right? The government bond yields are nothing.
Zilch.
Right, so it's all spread. But when you think about it, it's a very high quality market, a 50% double B market, unlike the U.S. market. There is no energy component, which makes it attractive, and they're in an earlier part of their recovery. So when we think about what's happening in Europe, the crisis was really 11 and 12, a banking crisis. So those companies are still in their improving sector. The economy is doing pretty well. There's potential for upgrades. So you go from double B, rising star, you become investment grade, spread compression. So European high yield is actually our top idea here.
So finally, how can investors get access to these kind of investments? If you want GE stock, you can go out and buy GE stock.
Right.
It's not as easy to do what you're suggesting here, so it sounds like it's probably a mutual fund or ETF play.
Yes, I think it is a mutual fund. It's an active play above all things, because the indices are basically weighted to the debt issuers. The indices have energy in them if they're high yield and have a lot of names you don't want. If we even think about the knock-on effects of the energy sector in investment-grade corporates in the U.S., if somebody out there makes a widget that goes into something that has to do with shale oil rigging, and then you don't want to own that name. So you want to be selective in your credit selection, so active management. I think there are three things that I would focus on in the JPMorgan fund complex. The first is we run a pure core bond fund. It's called the core bond fund. It's a true core. It doesn't have an exposure to high yield. It doesn't have an exposure to derivatives. What we're trying to deliver you is a better ag-like experience.
So it plays in the same space as, say, the Vanguard Total Bond Index, but it tracks only the issues that you think are going to do better.
Right, we're looking for actually better spread products. So we might own more mortgages, and not agency mortgage, but things like DUS bonds, multifamily bonds, where we can get paid for our credit work. So we're trying to deliver you a better ag-like experience, negative correlation to equities, low volatility. Now, if you want to add a risk component to that, there's two things you could do. You could instead own our Core Plus Bond Fund, which is a tactical core, or flexible core, that can dial up or down an allocation to risk, where that risk is, and then uses a macro overlay to take advantage of things that are happening with monetary policy. For instance, last year we had a curve flattener on in that fund. It delivered 40 basis points of excess return. If you want to build your own portfolio, we have a tactically managed fund called the Global Bond Opportunities Fund that can go really anywhere in the world, looks to take on risk, higher volatility, but can also tactically not be in the areas we don't like. So we're very light, for instance, in emerging markets. I think those three opportunities really reflect our best ideas.
Now, obviously, you're paying for that active management,
Absolutely.
but they're able to clear that hurdle.
Exactly right. So with Core Bond, we're looking to deliver you the ag, not less fees, but an experience after fees that's the ag or better over a rolling 3-year period. And I would say that our fees for our other funds are actually very attractive versus the risk-adjusted returns that we're able to deliver. And you really are you're paying for active credit selection today, and that's particularly important in today's market.
Thanks very much, Priscilla.
Thank you, Jack.